Welcome to my channel. I'm Dr. Romano. In today's video, we're going to be discussing the future market as we know it. The future market will be investing in funds of funds, not directly into hedge funds. Because of 2008 collapse, the investment banks realized they were really bad at managing capital, and so the government then allowed them to invest in hedge funds. And so you've seen after 2013 approximately, you've seen an enormous amount of capital go into the hedge fund industry from the investment banks. But then there was an issue that the cryptocurrency market became hot, and once again, investment banks were investing in cryptocurrency, hedge funds, etc. Before we continue the video, please remember to subscribe to my channel and do thumbs up. It's right there, it doesn't hurt, and it will really help me out since I do this for free. And I want to help the public improve their investment selection process. Thank you so much. Now, my previous video was about the equities market and why the equities market is so valuable. Keep that in mind. A funds of funds is a portfolio of hedge funds. And every portfolio, in my circumstances, my expertise, it should be between 7 and 8. That is the actual magic number. Because if you include more, your returns get watered down, and if you include less, your returns actually do worse when the market tanks. The goal is to try to smoothen out your return per year and try to create a return in any type of market and any type of market condition. Keep that in mind. That's the difference between you investing directly into hedge funds instead of investing in one or two, because you're not, let's say, a billionaire that could set aside $100 million to invest in a hedge fund portfolio. Let's just use that as an example. Because you're not a specialist of selecting and deselecting hedge funds, again, just meeting the hedge fund manager and interviewing him or her, interviewing them is not a basis to allocate money to. And there's a lot of issues that come about with your split-second methodology on whether or not you would invest in that hedge fund or the other hedge fund. For example, investors don't understand that when you look at the hedge fund manager's resume and you do your research on him, don't ask that person where they went to college. Don't ask that person where did they work before. That's all irrelevant information. And if you're asking these types of questions, then it's particularly elementary of you. And that's why you should not be investing directly into hedge funds. Whereas someone who has the expertise, the research knowledge, the experience on a track record of selecting 7 to 8 hedge funds, then that person evidently has created a track record over 8 years or whatever it is, that typically they go back 5 years. And this is a very important number, which is 5 years. The reason why investors have to go back 5 years to look at their returns is because there's a market cycle of 8 to 10 years. So just happens to be, if you started investing in hedge funds in 2018, then you have the first 3 years to analyze, because the hedge fund manager during the 2020 collapse would have proved themselves. But also you have to be careful, because just because they did really well at that time period, also how much capital did they have under AUM? So these are all questions that you have to ask. This is why for investors, if you have a lot of money, you should be focusing on the funds of fund industry. Finally, now that the cryptocurrency market has diminished And for a while, until the SEC and the government changes the law, makes it more regulated and more safer to invest in. Secondly, we have the governments coming out with their own cryptocurrency. That market is going to be pretty watered down. It's going to be like the commodities market, basically. It's not really a powerful market. Whereas the equities markets, once again, are taking over. And again, investors, investment banks, family offices, all these people realize that the equity market is really the market you should be focusing on, not following the bandwagon. Secondly, and another important issue is the future as we know it. Because we have so many more people today that made a lot of money, the funds of funds industry is the future investment market. And this is a very important understanding, because by around the year 2000, a lot of people went and started hedge funds, etc. And you've seen that the industry of the hedge fund industry started to take off. Then by 2010, everyone realized, well, they shouldn't be putting their money in the investment bank because they lost all your money if it wasn't for the federal government to lend them money. So apparently they lost out, the investment banks, and again you've seen the rise of hedge funds, thousands of hedge funds, and their AUM grow even further after 2013, around that time period. And so again today you've seen for the past 7 years, only the cryptocurrency funds grow, whereas the equity funds, they weren't growing so much. But now the change in the cycle is restarting again for the hedge fund industry. And so you're gonna, as someone who has a couple $1 million at the minimum, based on the state where you live, there's certain restrictions. Let's say Wyoming and Colorado, I don't know what it is exactly because it changes, but let's say for a funds of funds, the minimum investment for a client is $2.2 million for Wyoming and Colorado. So in other words, if you have $10 million, let's say, laying around, then a portion of that you should be investing in a funds of funds. As the funds of funds industry grows, the larger hedge funds realize that it's not actually beneficial to have one hedge fund. They need to give each trader their own hedge fund, do not have any ownership in that company, and become the funds of funds manager. And if they have 100 traders trading for them, then clump every 7 traders in one funds of funds. And since they have so much capital and so many traders, they could organize those returns for each funds of funds so that it actually doesn't get watered down, but it increases and improves the return. For example, my methodology on selecting and deselecting hedge funds, I do follow several number of hedge funds, and based on the hypothetical portfolio that I created based on my research as a PhD, my average return is between 25 and 30% on average per year over a 5-year period. You have to remember, if I was the owner of the hedge fund, okay, and I had 8 traders trading for myself, then I would be fixed in to one type of risk profile. Whereas if I was a big hedge fund manager, let's say, like, you know, Steve Cohen or Ray Dalio or Ken Griffin, since they do have billions under management, and I don't know how many traders they have trading for themselves, but when they take all that average return of all their traders, their returns are watered down. And so this is why they need to separate it into a funds of funds. And so if they have 32 billion under management, then they basically should have 32 funds of funds, with each funds of funds having 7 to 8 traders trading for them. And they could reorganize each trader in each funds of funds to increase and improve the return for each funds of funds, since they have 32 funds, let's say. Then they could also create an umbrella company and go public and create a basket of funds, and they could make billions and trillions of dollars on that in the future. And that's what my plan is, because I realize now that the traders that have a track record and are doing really well are very valuable. Allocate assets to them, how to select them, and that industry is extremely important. So I seen this trend 10 years ago, 15 years ago, that the future would not be in the hedge funds, it would be in the funds of funds. It was just a matter of time until the cryptocurrency market would collapse. And so once again, the change is going to happen, and you're going to see a rise in the funds of funds. Now, of course, if you are working for a portfolio desk for funds of funds, I don't believe that you are equipped with selecting and deselecting funds for a funds of funds. I don't believe that you are equipped with selecting hedge funds for a portfolio. There's a lot that goes in on it. You have to understand the forecast for the next 3 to 5 years in the markets, where it's going, and you'll know which hedge funds will do better or worse based on their risk profile. And so there's a lot to know, but just because you have 20 years experience working for a funds of funds or even an investment bank as a portfolio manager, no, I don't believe that you are equipped with really understanding what you have to do. And it's all about track record. You create a hypothetical funds of funds and show me what you could do, etc., and all the different type of market conditions. And if you could do that, then that's great. And I would really appreciate people if they want to send me their hypothetical funds of funds information to my LinkedIn profile. It's my first and last name and then Dr. Hedge Fund. So Anthony Romano, Dr. Hedge Fund on LinkedIn. You could send it to me and I'll take a look and I'll analyze them for you. What I think, what's my prediction on how much they will make in the coming market conditions. The market conditions in the next 3 to 5 years are going to be a very different type of market to trade in, because interest rates really affects a trader's return and profit. Just that's how it works. But again, you will have more money go to the hedge funds. You will have a lot more companies raising capital, being pulled out of the cryptocurrency markets, etc. So the change will happen, and you will see that the ideology of investing in a funds of funds has double the management fees. Why would someone do that? Well, that's because that's where the market is now. So again, if you're able to produce a really nice quality return, big deal if you have to give 30% to the hedge fund manager and to the funds of funds, as opposed to being greedy. At least your risk profile has been reduced dramatically because you're investing in a basket of hedge funds as opposed to 1 or 2, and you meeting them, liking them subconsciously because of their personality or the way they look or how articulate they are. There was a lot of interviews of people who invested in Sam Bankman, not that he was a real hedge fund, but the fact that people did invest in him and what they said, why they invested in him, it was just bogus why they did what they did. Whereas the people that are actually most proficient at managing a funds of funds, they're not growing because maybe people don't like their personality or how they speak or how not articulate they are. So again, your methodology on how you select an investment, just because you have $100 million doesn't mean that you know everything. And that's very important to understand. Just because you made money in your career does not mean that you know how to make money in the next deal. And that's something that Mark Cuban said. He said it was easy to make $1 billion, but it's hard to keep it. Now, of course, if you watch my YouTube channel, I tell you how to keep it. You create a private foundation, you create a donor active fund, etc. Every time you have to pay tax, you dump it in there, and so forth. You'll have to just watch my other videos. So that's where I see the future. That's where I see the future going, is to the funds of funds. And the funds of funds will actually improve market conditions. And yes, there'll always be volatility and people trading and leaving and going in a market, but it will actually help the investor to make a steady return over their lifetime. Of course, those hedge funds that don't produce, they go away. Whereas when you find new hedge funds that are producing, they increase in value. And so that's my take on the funds of fund industry. It's very important how you reevaluate your understanding of them. I want to thank you so much for watching my video. Please remember to subscribe to my channel. It really will help me out if you subscribe to my channel. And please do thumbs up. It's right there. Please press the button. Thank you so much.